But this is someone I knew in real life. I watched her go from 3 units to 90 units. So that notion of working with other investors became really palatable to me. And from there, I started to learn more about that process, and it made it much easier.
John, welcome to the show today.
Hey, Michael, thanks for having me.
Tell us a little bit about yourself. How did you get started with apartments?
Well, like many of your listeners, I started off in corporate America with the W-2 job. I actually worked in advertising and marketing for 15 years. And the first company I worked for, most people have heard of it, General Motors. But I was there from 2007 through 2011. So if you have a time machine and you remember this, that was when we went through bankruptcy. So I was there and I watched it firsthand. I watched my peers get let go. I watched the anxiety everyone had. And I realized that I really needed a plan B. And real estate kind of became that plan B. So moved to Chicago in 2011 and started investing in smaller multifamily, and then eventually scaling up deal after deal. And then eventually got to our first larger syndication deal, which was 192 units in San Antonio, Texas. And from there, we really never looked back. We just kind of stayed into the larger apartment buildings, partnered with other investors to scale the portfolio.
Now, why did you get started with apartment buildings? There's a lot of people, they'll spend years, investing in single family houses, and you somehow skipped that stage. What made you? What apartments the way to go? And number two, why? How did you have the confidence to go right into apartments?
Well, the first thing was just educating myself. Every book I read, every, now podcast, but, back then it wasn't that many podcasts. But everything I read, everyone I talked to, they all said they wish they started an apartment sooner. And, talking to 10, 15, 20 people, and they all say the same thing. I'm like, all right, well, why don't we just start there? And it was small. It was 2 to 4 units, but it all made sense. There was a book I read, Making Money or Small Income Properties, Robert Kiyosaki series with Ken McElroy, all those books, they talk about how to invest in smaller multifamily. So that's exactly where we started. And I was in Chicago. Chicago has a lot of 2 to 4 unit properties. So there are actually more 2 to 4 units than single family homes in most of the neighborhoods. So it was very common and it was an easy way to get started. So I think all of that made it easier for us. And my first property was a house hack. And if you are, early in your journey, I think it's a great strategy. We bought a 2-unit building. We house hacked it. We used FHA financing, just 3.5% down. So I was able to buy this $360,000 property really with less than $10,000 out of pocket. So great strategy to get started. And again, building the confidence and letting it snowball from there.
Yeah, getting that first deal is so key. Now, at one point, you probably ran out of money. How did you continue buying? What was your capital strategy there?
That's exactly what happened. We kept running out of our own money. So we bought the 2-unit, saved up some money, bought a 3-unit, saved up some money, actually did a line of credit on the first property. We bought an 8-unit property. And I remember the day we closed on that 8-unit, I thought I would feel this sense of, euphoria and excitement. And I just kept thinking about how long it was going to take me to save money to buy another property. And I was really sad, just like you're building this up, you're doing everything the right way. But I'm looking at my bank account and I'm back to broke, right? I took this 6-figure check and put it on a down payment for this 8-unit, and I'm right back to climbing the mountain again. And that's when I really got serious about working with other investors. And I heard of it from a conceptual standpoint, but I hadn't really considered it for myself until that point. And that's when I realized, like, okay, you know what? We need to take this more seriously and learn how to work with other investors and started down that path.
So we have kind of similar backgrounds. I actually started in Chicago as well. I think we talked about this before, but we were just buying these 2 to 4 units. They're portfolios of them. And I don't know what areas were you in?
So I was on the north side. So I bought in North
North
Center and Avondale and some of those areas.
Yeah, we went straight south side. We went right in. So we bought portfolio packages, but had a very similar situation as far as just a lot of these things, you run out of money. And so how did you actually make the transition out of that and into something bigger with your building your relationships and getting investors?
I mean, networking is so important. It's so critical. And for me, it really started with a seed being planted. So a good friend of mine, Bree Schmidt, I met her when I, first moved to Chicago and started attending these networking events. And when I met her, she had 3 units in her portfolio. And she went from 3 units to 9 units. And then she went from 9 units to 90 units. And I was just floored. I'm like, wait a minute, doesn't compute. Like that just doesn't add up. How do you go from 9 to 90 units in like less than a year? And I remember being so bothered by this and not being able to figure it out that I asked her to go to breakfast. And I took her to breakfast and I flat out asked her. And in my mind, I fully expected her to tell me that like she had this rich uncle or her grandfather passed away or something where she inherited all this money and was able to invest. And that's not what she told me. She told me that she actually had some investors out west who had been reaching out to her for a while and they wanted to invest with her. And she finally decided to partner with them. And that was the first time that I saw this happening in real life. Because we talked about the books and the podcast and all the other resources, but I didn't know those people. Those are just, figures in a book or a podcast to me. But this is someone I knew in real life. I watched her go from 3 units to 90 units. So that notion of working with other investors became really palatable to me. And from there, I started to learn more about that process and it made it much easier. So I would say just surrounding yourself with people who are actually doing it, whether that's joining masterminds, networking events, getting a coach, a mentor, being around people who are really doing it, it removes some of that concern or that risk that I think a lot of people associate with scaling or working with other investors.
Yeah, I think it's so important to kind of help expand your mind. I think you can only read so many books or podcasts before you're still held back by your own experiences and limitations until you see someone else do it, or even more importantly, when you do it yourself. Now, how did you what were some of your false beliefs or limiting beliefs around raising money? A lot of people's like, oh, I can't raise money. I've never raised money. I don't want to beg people. I don't want to ask friends and family. Like, what were you struggling with at the time? And then what was your breakthrough? When did you kind of say, oh my gosh, I can do this?
All of that was my limiting beliefs, right? Didn't have money myself. I had some money, but not enough to go out and buy the bigger stuff that I was looking to buy. I didn't think I had a network. My family or friends didn't have money like that. I didn't want to beg people to invest with me, just all of that, I never really asked for money. And in my mind, everything I'd done up to that point was somewhat self-made, right? Like I'm the first person in my family to even go to college, first person to graduate. I was the youngest advertising executive at General Motors. I was a young rising star in the advertising world. So in my mind, all of this was built off of my hard work and labor. So to go out and ask other people to invest with me, it just felt counterintuitive to what I wanted to do. The big breakthrough for me was recognizing that I was thinking about it completely wrong. And that started really at the time when I finished that 8 unit, because I was talking to people where they were seeing me invest and they would express interest in learning more. So I would tell them how to do what I was doing. And I would just watch their eyes glaze over. Like they had no interest in learning all the things I had learned, reading all the books, attending they didn't want to do that, right? But there was interest in investing in real estate without necessarily being active. And now I know that as being an LP or a passive investor, and they were interested in investing, but I didn't put 2 and 2 together at that point. So the big breakthrough for me was recognizing that we had a service that we were offering. Instead of me asking people to invest with me, I was providing an opportunity for them to make money alongside me. And it may feel like a little nuance, but it's really important. I was the one providing the opportunity, not the other way around. These weren't people, helping me out. And yes, I benefit, but it wasn't about them helping me. It was really about me offering a service that could help them achieve their own financial goals. And the moment I flipped that switch and changed that perspective, it made it much easier for me to talk to investors.
Okay, so what impact did it? Give me an example of how that simple shift actually affects how you speak to people or investors.
Yeah, so I will tell you, the very first deal we raised money on and brought in some partners. I brought in some family and friends, and my brother-in-law actually invested, and he said thank you. Once he kind of committed to invest, and he said thank you when I was going to say thank you, and it made me pause and realize all these things we talk about, the benefits of investing, cash flow, depreciation, tax advantages, the fact that this is a diversified investment vehicle. These are things that people want. And this was a person who was facing a 6-figure tax bill if they didn't have a vehicle like this to invest in. So I helped him solve a challenge that he was facing. So when people are thanking you, when you are helping people achieve their own financial goals, yes, you're going to benefit. And it's easy to look at it from your lens. But when you can put yourself in their shoes, it makes it a lot easier for you to understand the value you're providing to them. So that was really key for me. And I think just talking to people and actually listening to why they are interested in investing, what are you hoping to get out of it? that allows you to know that, again, it's a business, it's a service, just like any other business, right? If you're a CPA or an attorney, or you got any other business or service that you offer, you're going to have clients who are looking for those services. This is not charity. And it took a minute to process that. Yes, even though I'm benefiting, I'm not a charity case, right? It's not, we're going out here and begging people to invest in these deals, and they're never going to see anything. Like, we're offering really strong returns. We're offering great investment opportunities, and you have to really believe in that. So that confidence is absolutely critical. And you have to just take that time to truly understand what you're offering. How do you, protect your investors and make the right investment choices when you're offering those opportunities?
Yeah, that's great, John. It's absolutely true. Going back to your location though, you're in Chicago, and you're probably at that point thinking, maybe there's some better locations to get better results, right? For these investors. Talk to us a little bit about your process of exiting Chicago like I did, and maybe looking elsewhere for better services for these investors.
Well, Garrett, you get it, right. Chicago I enjoy living in the city, great city to live in. When it comes to investing, not exactly the friendliest environment to be in. So part of that process for me was recognizing that when I was looking to invest, there were certain return metrics that I was comfortable with. But when you have partners and you're given 50, 60, 70, maybe even 80% of the profits to someone else, well, those deals need to look a little bit different. And Chicago's really challenging when it comes to, being landlord friendly and things like that. So we did start to look in other markets. I started looking at markets I was more familiar with. Cincinnati was one. My wife is from Cincinnati. I knew eventually we were going to move to Cincinnati, which is where we live now. So that was the market I looked at. But the challenge for me was really trying to learn another market. Like, I knew in Chicago, hey, if you go past Damon, the neighborhood changes. If you go north of this, that's going to be a different bracket. This is the school district. I had a hard time figuring out, like, what are those parameters in these other cities? And a lot of the people I knew were all investing in Texas, not necessarily in the Midwest. So some of the things they were doing didn't really fit in my market. So I actually had to set out on a journey myself to learn this. And that kind of led me to my podcast, which at that time was Target Market Insights. Now it's called Multifamily Insights. But we set out to learn how to find the best places to invest. And the reality for me was, I just wanted to interview people and ask them, how are you figuring out where to invest? And after talking to so many people, a lot of the similar themes kind of came up. They talked about population, talked about job growth. They talked about industry diversification, ease of doing business, multifamily trends. So you can start to take that information and create your own framework based on that. And that's exactly what we were able to do. And, looking in Cincinnati and Midwest markets that are growing, we were able to apply that lens and find deals that fit our own criteria.
There's a lot of people listening, watching right now, and they're scratching their head going, man, what is going on right now? And maybe I should wait. Maybe I should just wait till things get a little better. And I'm wondering if that's the right strategy to do, if that's the right thing to do. And I know we wrote a blog post on this 3,200 unit foreclosure in Houston in the Wall Street Journal, which we saw. And we've been spending a lot of time educating people about, what that really means. But nevertheless, I'd love to hear your thoughts about what you think what went on in that particular property, something about it, and if that's a sign for bigger things to come.
Well, that it's always unfortunate, right? I mean, I think you come from two different mindsets. If you are an abundance mindset person, you never want to see anyone struggle or suffer and have a deal fail. Obviously, as investors, we're looking for opportunities, but you never, I'm not a guy who wants to celebrate someone else's failure. So I think it's disheartening, sad for the investors in that particular situation. But I think there are also a lot of red flags, a lot of mistakes. A lot of the basic blocking and tackling things were missed. High leverage. They had from my understanding, a C class, maybe C minus property, needed a lot of work. None of that work was actually done. They did not get a rate cap. So the interest rate was floating. And as it changed, they pretty much were, subjective to whatever that interest rate was. And it got to the point where they couldn't even implement their business plan, and they were just trying to stay afloat. And ultimately that ended up failing. So lots of mistakes going on there. And I would say that person won't be the only one who suffers that fate, unfortunately. But as investors, I think it also reinforces the fundamentals. And it's the reasons you listen to shows like this to learn how to be a solid apartment investor. it's not about there and finding the deal of the century. It's about, first and foremost, preserving your capital and then figuring out ways to grow it. And if you can invest in cash flowing assets that appreciate over time in areas where there's demand, you should be okay. You have to put in the right loan product or have the right, checks and balances put in place. And again, that investor didn't do that. And I think for all of us, it's just a reminder that the numbers don't always go up. It's been a really bullish market for the last 5 or 6 years. But I think it's really important for us to recognize that those fundamentals are there for a reason. We have to make sure we pay attention to that whenever we're making an investment.
So we're getting really good at our operations. Obviously, I mean, we're as best as we could possibly be at this point because we understand how important that is. I'm curious, what kind of things are you guys doing on your side to protect yourselves in this environment?
Yeah, a couple things. So first and foremost, I think you have to look at the business plan you have for the property, right? So if you have a business plan where, let's say it's a medium value add, you're going to go in and put, $5, $7, $10,000 per unit in increased rents. You want to make sure you're still able to do that. In some markets, many markets, rents are not growing as fast as they did before. So you want to make sure that those market rents are still there. And if not, maybe you cut back on some of that spend. Maybe you hold a little bit more capital for operational reserves. So we're paying attention to those kind of things. Are we still hitting our metrics? Are they starting to soften a little bit? What pivots do we have available to us? We have some deals where we have, long-term fixed debt in place. On those deals, we're kind of letting investors know, hey, you know what? If the market gets a little crazy, we're going to ride this thing out for a little bit. We're in a good place. We're cash flowing. Market's good. Long term, we know real estate tends to go up in value. So we feel very comfortable with the long-term outlook. But again, if we have to sell in 6 months or 12 months, I don't know where the market's going to be. So we're paying more attention to the long game, and anything that does have a short-term position, we're trying to reposition so we have more flexibility. I think flexibility is key. You want to be in a position where you control the exit and not the market or not your loan. So making sure you have that flexibility based on, again, the operating capital you have, reserves, the loan you have secured, all that's really, really, really important in today's economy.
Well, let's talk about that because people always say, "Oh, get fixed term, interest loans, like 12 years, lock it in, right? Like it's the safest." But talk about how that limits the exit on ability to refinance or sell, because I'm not sure people are actually aware of the limitations of those kinds of loans.
This is a great point, Michael, because a lot of people say, hey, you know what? We only want to do fixed debt right now. We don't want to do any kind of bridge debt. And it's really important for people to understand that you want to have the right debt based on the business plan. And it comes down to the property. If you're going to, let's say you have a heavy value add deal and you're going to increase rents by $400, $500, you're going to create a lot of value in this property. Well, if you have a 10-year fixed debt on that, you really won't be able to tap into the equity you've created. So if you do this and you knock that out in 18, 24 months, you kind of have to just sit there because you can't sell. The prepayment penalty is too high. You can't really refinance. You still have a big fee there. So you're stuck just sitting on this equity, and it's not the most effective way to capitalize for yourself and for your investors. So in that case, bridge debt, bridge financing would be ideal. Now, you still have some risk there with the bridge debt, so you need to offset that. You can offset that by having more reserves, having a higher, CapEx budget, making sure you do other things to anticipate that. But there are a lot of different ways to look at it. On the flip side, if you have a more stable property, let's say it's in a good location, it's cash flowing, you think demand is going to continue to grow, but it's not really a huge value add deal. You can push rents $50, maybe $100, but not to the point where you're going to create a ton of value over the next 24 months. Well, in that case, maybe you want a fixed loan. Maybe you do want that long-term debt and you want to be in a position to sell if you get blown away with an offer. But if not, you got a great cash flowing property here for the next, 5, 6, 7 years.
Are you throttling your acquisitions right now, or are you looking for opportunity? And if so, what are you looking for?
We're definitely looking, and I'm a firm believer that many investors should always be looking. There's some folks who shouldn't. I think if you're at a point where you and your company are, you've reached all your goals and you're simply preserving capital, then you can cherry pick. You can sit on the sidelines and just buy when it makes sense to buy. But, this is like the only industry I know of where as a business, we can decide that we're just not going to do business. Could you imagine owning like a shoe company and just deciding, market's a little crazy right now. Let's just not produce shoes right now. Let's just wait until next year to produce shoes. The reality is for us and our investors, we're all trying to grow our capital. We're all looking to park our capital in cash flowing assets. We're looking to reduce our tax liability. We're looking to grow our assets. So we have to find deals for that. And for us, I just think that makes the most sense. The alternative is to do nothing and let, inflation wipe away some of the money we have sitting in our bank accounts. And that just seems like a bad idea to us. So it's not that we're going out and buying anything. We certainly want to be pragmatic in our approach. But I'm a firm believer that you should always be at least looking and analyzing deals, because the market does change very fast. And you won't know the market has changed until it happens. So for us, by analyzing deals, seeing where we're coming in, talking to brokers every day, we get real-time feedback on where the market is headed, where interest rates are, how the industry professionals look at the market real time, like today. So you only get that if you're looking. If you're on the sidelines waiting, by the time things change, people are already doing deals and taking advantage of that current market landscape.
So John, one of the things we're facing right now, and we're just seeing in general, is the investor sentiment is way down because either they got in a deal in the last 2 years, it's not producing what they thought, or they're just frozen because of what's happening in the market. How are you guys looking to overcome that type of situation when all this opportunity seems to be ahead for us?
Yeah, that's a real challenge. I think, you guys were having, a lot of folks are facing right now. And part of it is just having as many conversations as you can with people, letting them know what's going on, why it's going on, but also going back to those fundamentals. I think the reality is the last, 5 or 6 years have been great for most apartment investors. And if you were accustomed to getting in and out of a deal in 18 months or 24 months and seeing a 2x, 3x return on your capital in that time frame, that could be great, but now we're going back to what we pretty much have been underwriting for that same time frame, is that, hey, 5 to 7 year holds, maybe a 2x multiple on your capital over that 5 to 7 years. And it's not quite as sexy as, maybe that 2x return in 24 months, but that's the reality. And I think we just have to understand that there's always these market cycles. But again, apartment investing is one of the most, secure and stable ways to invest capital. And that has, remained true over the long haul. And even with these, current instability in the marketplace, I don't think that changes too much.
What are you most excited about in the next 6 to 12 months?
Deal flow. I mean, for us, particularly because we focus mostly on the Midwest, and in the Midwest, because we don't have, again, the highs aren't as high, the lows aren't as low. It wasn't quite as wild for us over the last 5 or 6 months. It was or 5 or 6 years. And finding good deals was a challenge, but we're seeing more opportunities now than we've seen in the last 3 or 4 years. With that said, rent growth is strongest right now in the Midwest compared to many other markets. And I think that the fundamentals that we believe in are starting to shine through. So cash flow first and foremost. If you've got cash flow, you get to decide when you sell an asset. If you have cash flow, a strong market where there's good demand, that gives you a lot of control and flexibility. So for us, we're starting to see more opportunities now. I think sellers are recognizing that they may have, missed that opportunity to really top out on the market. But if they need to sell, there's still an opportunity to sell at a good number today. And, if they continue to wait, maybe that continues to drop. So we're starting to see more and more deals and opportunities. So we're trying to be aggressive in our actions, in the sense of, we want to look at a lot of opportunities. We want to ramp up our partnerships and see more deals and opportunities. And ultimately, we're hoping that results in doing more deals in this year.
Yeah. What do you think is contributing to the increased deal flow? What do you think has been going on? Because it was slow. We're starting to see some deal flow as well. We're more in the Atlanta area, and I think Atlanta was more through a huge surge in rents and prices, and it's come down since then. So we're not quite seeing it yet. But what is contributing in your market for higher deal flow right now?
Well, I think, loans coming due is one thing. I just did a presentation at MFI and one of the things that jumped out was there's a report by TREPP, and there's $88 billion of apartment loans that are coming due over the next 24 months. Of the $88 billion coming due, 42% of those loans are considered to be at risk for refinancing. And that's because they either don't meet the basic DSCR requirements, debt yield requirements, or LTV. So when you have those figures, a lot of owners are looking at it, and maybe they underwrote to sell, at a certain cap rate on the exit. But because interest rates have shot up as much as they have, those cap rates are no longer accurate. So they're trying to get out while they can. No one wants to be there with your loan expiring and praying you get the offer you need, or praying that the bank will, give you the assessment that you're looking for. So if they have time on that loan, they're looking to do something now. They're looking to do something while they have an option for a plan B or a plan C if necessary. So I think that's a big chunk of it. I also think that there are owners who have just made their money. They're ready to retire. They're ready to get out of the game. COVID was a crazy time frame where, I think some people maybe held on and wanted to see what's going to happen there, or maybe they tried to sell, but the market just wasn't right at that time. Rates shot up, so maybe they got a little greedy. But I think now they're recognizing that, what, everything we're seeing is that the market will take a slight decline overall. But I think if you're in it for the long haul, it makes sense to hold on. But there are a lot of people who I think were trying to time the market or trying to get out of the market. And maybe they've been waiting for the reason to, or a sign that now's a good time to get out. And I think they've gotten that feedback.
Yeah. So what I'm hearing is there's opportunity, but we're reminded that this is a long-term hold strategy, not a get quick strategy. And I think we got spoiled over the last 24 months. And I think now it's back to normal. And we have to educate everybody that, hey, we're back to normal. We no longer have to put our EMDs hard, which is good. So that's an improvement as well. So yeah, thanks for bringing that perspective, John. How can people connect with you and find out more about you?
Yeah, two easy things. One, we've got a great show called Multifamily Insights. It's available anywhere you listen to podcasts. And then if you just want to wrap your head around kind of this concepts, whether it be being a passive investor, an active investor, we have a sample deal package on our website, casmoncapital.com/sample deal. And it's not a real deal. It's just a sample deal. So you to wrap your head around some of the terminology and just the deal structure. I know when I was trying to do my first deals, that was the thing that was kind of hard for me to grasp. So if you want to check that out, just go to casmoncapital.com/sample deal.
John, it was great having you on the show today.
Absolutely. Thank you for having me, Michael. Garrett, great talking to you.